Oh, good afternoon and welcome. My name is Stacy Rundle. I'm with the State Department of Retirement Systems, Education and Outreach, and I'm going to be covering PERS Plans 2 and 3, DCP, and I'm also going to demonstrate some of the tools and resources that we have on our website that can help you achieve financial independence in retirement. If you have questions for me, I will stop for questions a couple of times during the presentation at the end of each section, but I will also take questions at the end. Now, if you send questions in chat, I have a hard time seeing them when I'm presenting. So if someone can read them to me, Grace, is that something you're able to do?
Yeah, I can totally do that. Do you want me to interrupt them or interrupt you as they come in, or you want me to just keep track of them?
Yeah, if you can keep track of them, and I'll stop, like I said, a couple of times during the
Yep,
presentation and take
can
them at
do.
that time. Okay, thank you.
Mhm.
So Dear S, we administer 8 retirement systems with 15 different plans. And I will cover some of the basics of plans 2 and 3, PERS 2 and 3. But to take a deeper dive, you can review your plan webpage from the DRS website just by selecting it from the plans menu. You can also get to know your plan by attending a live webinar or by watching a webinar video that's available on demand. And both can be found from the events page of our website. Just select the site index to find the events page. So I'm going to walk you through 3 different career stage scenarios to demonstrate our online tools and resources. But no matter where you're at in your career, you may want to stay for the full presentation because a lot of them can be used in any career stage. Sam is in the early stages of his career. Marty's in the middle stages of her career. And Pat is nearing retirement. Sam was just hired into a PERS eligible position and he has a planned choice to make. He would also like to learn about DCP and how to enroll, and he would like to register to access his retirement accounts online. Sam can choose to join Plan 2 or Plan 3, and he has 90 days from his date of eligibility to choose his plan. He would like to learn more about the plans, so from the DRS website, he selects New Hire from the Life Events menu, then selects Choose a Plan from the New Employees page. Now from the Choose a Plan page, he watches the short Choosing a Plan video, which summarizes plan choice. He then scrolls down the page to learn more details about both plans. Once he has decided on a plan, he selects Ready to Choose, completes the plan enrollment form, and submits it to his payroll office. So let's talk about some of the basics of plans 2 and 3. We'll start with a high-level side-by-side overview of both plans. Both Plan 2 and the pension part of Plan 3 provide a guaranteed lifetime monthly pension benefit once you're eligible. So to be eligible to retire, you will need to meet the age and service requirements of your plan. And they have 2 categories of retirement eligibility, normal and early retirement. Let's start with Plan 2. So if you're in Plan 2, you can retire with a full pension benefit at age 65 once you have earned 5 service credit years. Now this is known as vesting. So once you're vested, you're guaranteed a full pension benefit when you turn 65. If you're in Plan 3, you can retire with a full pension benefit at 65 once you have earned 10 service credit years, or 5 service credit years if at least 1 year or 12 months is earned over the age of 44. Can you retire earlier than age 65? If you're in Plan 2, you could retire as early as age 55, so between 55 and 64, if you have achieved 20 service credit years. Now, if you retire early, your benefit will be permanently reduced to help pay for the cost of receiving it over a longer period of time. The further away you are from 65, the bigger the reduction. If you're in Plan 3, you're eligible for an early retirement with a reduced benefit at 55, once you have achieved 10 service credit years. Now, for both plans, if you have achieved at least 30 years of service, the reduction factors are more favorable. Now, there is one exception to an early retirement with a reduced benefit. If you joined your plan prior to May of 2013 and you've earned at least 30 years of service credit, you can retire as early as age 62 with an unreduced benefit. Now, this is still an early retirement, but your benefit will not be reduced. Now, to learn more about retiring early, attend a live early retirement webinar or watch the webinar video that's available on demand. Now, both plans will use your years of service and an average of your pay to calculate the amount of your benefit. Okay, what does that really mean? Well, the longer you work and the more that you earn, the higher your pension benefit will be when you retire. And there's no cap on the amount of years you can work. The Plan 2 pension formula uses a 2% multiplier because it's funded with both employee and employer contributions. Now, keep in mind that contributions will have no impact on the amount of your benefit. Remember, your benefit amount will be based on your years of service and an average of your pay, not how much you're contributing to it. The state will adjust your contribution rate either up or down over time to reflect plan costs. You can find your current rate from your online account or from your plan webpage. Now, the Plan 3 formula uses a 1% multiplier, which is half of what it is in Plan 2, and that's because only your employer contributes to it. If you're in Plan 3, you're contributing to an investment program, and that will provide you with a second stream of income in retirement in addition to your pension. Now, anytime after you separate from service or retire, you can begin taking withdrawals from your investments. And at that point, you will have several flexible withdrawal options you can choose from. Now, for all plan members 2 and 3, how do we calculate your benefit? Let's look at that a little bit more deeper here. We take the benefit multiplier times your service credit years. Now, that's a credit that you earn while you're working in an eligible Plan 2 or Plan 3 position, times your average final compensation. And again, Plan 2 uses a 2% multiplier and Plan 3 uses a 1% multiplier. How do you earn service credit? You earn credit based on the number of hours you're paid for each month. You earn a full service credit month when you're paid for 90 or more. Chrissy, can you mute yourself? Thank you. That was pretty loud. Okay, so you earn a full service credit month when you're paid for 90 or more hours in a month. And 12 service credit months equals 1 service credit year. If you're paid for less than 90 hours, but at least 1 hour, well, then you might be earning half or a quarter of a service credit. That means it might take you longer than 12 months to earn a full service credit year. So how do we determine your average pay? It will be a monthly average of your highest 5 consecutive years or 60 consecutive service credit months of earnings. So for example, let's say you earn $300,000 of gross income before deductions over a period of 5 years. We will divide that by 60 to get to a monthly average of $5,000. Now let's take a look at a benefit calculation example. In this example, we have 25 years of service credit and an average final compensation of $5,000. We take the plan multiplier times 25 times 5,000 equals a $2,500 monthly benefit for Plan 2 and a $1,250 monthly benefit for Plan 3. Now, this is a gross benefit amount subject to federal income tax. Now, if you're in Plan 3, remember, you also have an investment balance to make up the rest of your income in retirement. So let's take a look at the investment part of your plan. When you joined Plan 3, that's when you chose your contribution rate. If you change employers, you will have 90 days to select either the same or a new rate with your new employer. If you don't select a rate, you'll default to a 5% contribution rate. Plan 3 offers a choice of 2 different investment programs, the Washington State Investment Board Investment Program and the Self-Directed Investment Program. Now, you can change investment programs at any time by completing a form that's provided by your payroll office. You can also find the form from the forms page of our website. And you can transfer funds between the two programs either online or by calling the record keeper via financial. If you directed your contributions to the WSIB program, the State Investment Board is investing them in the Total Allocation Portfolio or TAP fund. Now, the TAP fund is fairly aggressive. It invests the same way as our pension dollars are invested, so for the long term. It's a diversified portfolio of stocks, bonds, real estate, and cash investments. Now, if you request a fund transfer or a withdrawal, it can take up to 70 days for that transaction to complete. That's because the WSIB TAP fund is only valued once a month. That does impact the timing of fund transfers and withdrawals once you're eligible. The self-directed investment program offers two different approaches to investing. With the build and monitor approach, you take a more active role with your investments. You build your own investment mix from the funds available in Plan 3 and then monitor and manage them while you're working and in retirement. If you don't have the time to build a monitor and investment portfolio, or maybe just not comfortable doing so, well, consider investing in a target date fund. So the second approach offers a selection of target date funds called retirement strategy funds, in which investment professionals invest your contributions for you based on how far away you are from retirement. Each fund automatically rebalances and gradually adjusts their asset mix more conservatively as you move towards your retirement or distribution year. All of the funds within Self-Direct are valued every day the stock market is open. Anytime after you separate from service or retire, you will have an opportunity to convert your investment balance or part of it to a TAP annuity. With a TAP annuity, you will no longer have stock market risk or be at risk for exhausting your investment balance. You will receive a fixed monthly payment for the rest of your life. So in essence, you'd be creating another pension for yourself. The Plan 3 was designed to be flexible for an early separation from service and waiting to retire. If you separate from service early with at least 20 years of service credit and wait until 65 to retire, you will be eligible for benefit indexing. That means your monthly benefit will increase 3% each year to help you keep up with inflation until you retire or turn 65, whichever comes first. You could access your investment balance and take withdrawals from it to help you bridge that gap. So if you'd like to learn more about benefit indexing, your investment and withdrawal options, including the TAP annuity option, just review your Plan 3 webpage from the DRS website. Okay, back to Sam. Sam knows that his state is PERS benefit and his federal Social Security benefits may not provide all the income he's going to need in retirement. He checks with his benefits office and they tell him about DCP. Sam would like to learn more about the program, so he selects DCP from the plans menu of the DRS website and reviews the DCP webpage. So what is DCP? The Washington State Deferred Compensation Program, DCP, is an IRC Section 457B governmental plan. It's a voluntary supplemental retirement savings program meant to supplement your pension income in retirement. So the Department of Retirement Systems, us, we administer the plan, and we contract with a private organization, Voya Financial, to provide record-keeping services for it. The State Investment Board, they select and monitor the investment options, and the State Treasurer's Office, they're the trustee for the assets of the plan. So you contribute to DCP with automatic paycheck deduction. It's very low cost. The fees you pay are very small fraction compared to other plans available in the marketplace. And you can choose to contribute to DCP with pre-tax dollars or after-tax dollars to Roth. Now with pre-tax, you will defer federal income tax on contributions and earnings. You will pay tax on withdrawals. With Roth, it's just the opposite. You'll pay tax on contributions, but earnings or withdrawals are tax-free once certain conditions have been met. Now, unlike other retirement, excuse me, I'm gonna take a little sip of water here. Be right back. Okay, so unlike other retirement savings plans like 401k plans, as an example, with DCP, you will not be penalized for an early withdrawal if you're under the age of 59 and a half. In fact, you can take withdrawals from DCP while you're still working if you're 59 and a half or older. And DCP offers the same two approaches to investing that Plan 3 offers through the self-directed program. I'm not going to go through them again, but just to quickly show them here, that would include the build and monitor approach, as well as one-step investing, which are those target date funds or retirement strategy funds. The minimum contribution to DCP is $30 per month or 1% of your salary. And I'll talk about annual limits a little bit later. And you can access your account and make changes to it 24/7, either online or by phone. DCP accepts rollovers from other eligible or qualified retirement savings plans. Now, that includes Roth plans except for Roth IRAs. And you can access your DCP balance and take withdrawals from it anytime after you separate from service. And at that point, you will have several flexible withdrawal options you can choose from. If you're not already contributing to DCP and you would like to, just go to the DCP webpage and select enrollment from the table of contents. You can enroll online or complete an enrollment form and mail it in to us. Now, if you're new and full-time with the state, you may not need to do anything to get started. Excuse me. As of 2017, all new full-time state employees and some higher education employees are automatically enrolled in DCP at a 3% pre-tax contribution rate and investing in a strategy fund based on an age 65 retirement. So for everyone, anytime you would like to change your contribution rate or investments, please don't complete another enrollment. Instead, you would make that change either online or by phone. If you'd like to learn more about DCP, just review the DCP webpage or visit the events page and sign up to attend a live webinar or watch the webinar video. And so from the site index, that's where you can find the events page. Okay, back to Sam. Now that Sam has chosen his plan and he's enrolled in DCP, he's ready to set up access to his account online. From the DRS website, he selects Sign Up to Register. After selecting Sign Up, you will land on this page. So to register, just select Register Now on the right. And when registering, you will have 4 steps to complete. Accept the access agreement, validate your identity, establish your user ID and password, and then set up account security by providing a cell phone number that can accept text for multi-factor authentication, MFA codes. Now, once you've confirmed your cell phone number, you will get an MFA code that will give you temporary limited access to your account. We will also mail you a welcome letter with a security code, and you will be prompted for that security code once you've logged into your account for the first time. The security code will give you permanent full access to it. You will have 30 days to enter the security code. If you miss the deadline, just contact DRS and we will unlock your account and mail you another security code. You probably want to verify your address with us too, because that might be the problem. If you've already registered and provided an email address to retrieve your code, please log into your account and provide a cell phone number to retrieve it, because receiving it by cell phone is a lot more secure than receiving it by email. Now, once you have full access to your account, you can check on your contribution rate and balance, check on your employment history with past years covered employers, create benefit and annuity estimates, apply for retirement online once you're eligible, access your investment account, that would be DCP or Plan 3, and update your personal information. If you select My Account, you can view and update your mailing and email address, your phone number, and your beneficiary. If you select Plan 3 or DCP under My Investments, that will take you to your investment account that's held on Voya Financial's website. When you select either for the first time, you will be prompted to register to access Voya's website. After you've registered, you can use single sign-on for all of your DRS plans. You will not need to register again or enter the password you set up with Voya. If you have any trouble signing up or logging in, contact DRS for assistance. Grace, I think I'm going to wait until the end to take questions because I'm slowly losing time here, and I want to get through the information before we break for questions.
Okay, that's fine. I'm keeping track of them.
Okay, thank you. Okay, so Marty is in the middle stages of her career. She would like to estimate her pension benefit and check on her investment balances. She will look at some of the calculators to see if she's saving enough for retirement, and she will evaluate the DCP contribution limits to find out how much more she could be saving for retirement. So Marty selects mid-career from the life events menu of the DRS website and reviews the financial independence checklist. She checks off know where you stand because she expects to have her debt paid off by the time she retires. She reviews information about her plan from her plan webpage, and she is subscribed to DRS News for articles and updates about retirement. Next, she plans to create an estimate of her benefit to help her see or figure out if she's saving enough for retirement. To estimate her pension benefit, she selects the benefit estimator from her online account. She will create a normal retirement benefit estimate that she can use as a baseline for other estimates. She will then create an early retirement estimate to see what a reduced benefit amount would be, and an estimate of what her benefit could be if she was to separate early and postpone applying for her pension. She will then compare all three estimates to help her plan for retirement. To learn more about the benefit estimator and how to customize it, attend the Estimate Your Benefit webinar or watch the on-demand webinar video. So when you retire or use a benefit estimator, there are some important dates that you should know. If you're retiring from active service, your effective retirement date will be the first of the month following your date of separation. So you cannot retire in the same month that you separate. For example, if you turn 65 in June and separate from service, your retirement date will be July 1st. And you will receive your first pension payment the last working day of the month that you retire. So that example, that would be July 31st. And you will continue to receive your benefit payments the last business day of every month for the rest of your life. Are you in more than one retirement plan? Maybe you're in PERS and PSERS as an example. Well, if so, then you are a dual member, and dual membership requires plan coordination. That means you may not be able to create accurate benefit estimates online or apply for your pension online. You'll need to contact DRS if you have questions about dual membership or applying for retirement once you're within a year of retiring. To learn more about dual membership, just review the multiple plans page of our website, or attend a live webinar or watch the webinar video. Now Marty's in Plan 3 and she's enrolled in DCP. She would like to review both of her investment balances. So if you have more than one investment account with DRS, this is Voya's page that you will land on. And to review the details of either account, just select Plan 3 or DCP. And contact Voya Financial if you have any questions about their website. And from the calculators page of our website, you will find calculators that can help you set and meet a retirement income goal. If you select the savings calculator, you can estimate your future balance based on your monthly contribution and projected rate of return. And as a reminder, DCP offers both pre-tax and Roth savings options. Select Roth versus pre-tax comparison to compare the tax advantages of both options. Marty selects Retirement Planner to see if she's saving enough for her retirement. After using the retirement planner, Marty learned that she will need to save more to meet her income goal when she retires. She plans on increasing her DCP contributions, but she doesn't know what the limits are. She visits the DCP webpage and selects contributions and limits from the table of contents. Since Marty's under the age of 50, she learned she can save up to $24,500 this year. And she also learns that when she turns 50 or older, she can save an additional $8,000 on top of that. From her online account, she selects DCP under My Investments. That takes her to her DCP account held on Voya's website. And she selects contributions and savings to change her contribution rate. She sees another calculator and selects Take a Tour to learn more about it. And she would like to evaluate her overall financial health, which is more than just retirement. She selects Financial Wellness for additional tools and calculators. Again, contact Voya Financial if you have any questions about their website or the calculators you find on it. Marty recently learned that DRS has a podcast called Fund Your Future, which explores the basics of financial planning and tools for managing and growing your money. She would like to learn more, so she selects podcast from the news menu of the DRS website. And if you'd like to subscribe to new podcast chapters, select subscribe from the menu. Since Marty's in Plan 3, she goes back to the calculators page and scrolls down to the Plan 3 calculators. So if you are in Plan 3, select Retirement Savings to find out if you're on track for your retirement. And as I mentioned earlier, after you separate from service, you will have the option to use all or part of your investment balance to purchase a TAP annuity. Select the TAP annuity calculator to estimate an annuity payment. You can also find it from your DRS online account. If you'd like to keep your balance flexible and choose your own monthly installment, select disbursement schedule. And if you change employers, you can, again, you'll have 90 days to select a rate with your new employer. Select take home pay to estimate how different rates could impact your paycheck. Okay, so Pat is planning to retire within the next few years. She would like to review the retirement planning checklist and attend a DRS nearing retirement seminar. And she'd like to review her annuity options and other calculators available on the website. She selects retiring from the life events menu of the website. From the retiring page, she reviews the retirement checklist, which guides her through a timeline and items to check off as she approaches retiring. After reviewing the checklist, she's now ready to attend a DRS nearing retirement seminar. She scrolls down the retiring page to sign up for a virtual seminar. Now, as a side note, if you're unable to attend a live half-day seminar, all of the presentations have been recorded and you can find them from the events page of our website. At a seminar, Pat learned she can purchase a plan annuity. So what's an annuity? Well, the annuity is offered by the state or lifetime income plans that you can purchase, and you make the election on your pension application when you retire. Now, pre-tax savings from DCP can be used for the purchase, but Roth after-tax dollars cannot be rolled over to purchase the annuity. To learn more about your state annuity options, visit the annuity page of the DRS website. Or attend a live webinar or watch a webinar video. And if you're in Plan 3 and attend this webinar, you will also learn more about the TAP annuity. Pat would like to use her pre-tax DCP savings to purchase a PERS annuity. So from her online account, she checks on her savings balance and then uses the annuity calculators to create annuity estimates. Since Pat is retiring from a state agency, she's eligible for PEB retiree health care. She'd like to learn more about PEB healthcare, so she signs up to attend a Healthcare Authority PEB webinar. And you can find a link to that webinar page from the healthcare page of the DRS website. Now, as a side note, you can still enroll in PEB as long as you're eligible for an early retirement at the time of separation. So you can enroll in PEB if you retire from your agency or if you separate early and postpone retirement, as long as you're eligible for an early retirement at the time of separation. Pat would like to see what calculators are available to her, so she visits the calculators page of our website, scrolls down for additional calculators. So select Plan Choice if you're new and have a choice to make between Plan 2 or Plan 3. If you're completing a paper application, select IRS withholding to estimate your federal income tax withholding. If you apply online, you can find the same calculator from your online account. If at any time you withdrew your Plan 2 contributions, select Buyback to estimate the cost of restoring your withdrawn service credit. If you have DCP savings, select Withdrawals and Retirement to estimate a monthly payment and project how long your balance will last in retirement. Often when people evaluate investment options, they just look at past returns, but it's really important to look at fees as well because they can impact your investment balance. Select investment fee comparison to evaluate fees between funds in different plans you might be looking at. When you turn 73, you're no longer working. The IRS will require you to take minimum payments from your pre-tax savings each year. Select required minimum distributions to estimate those payments. And select Social Security, and that will take you to the calculators page of their website. And you can use their calculators to estimate your Social Security retirement benefit. Select life expectancy to project your life expectancy. Select retirement lifestyle to project how much of your pre-retirement income you will need based on your life plans in retirement. Select budget to create a budget for while you're working and for retirement to help you determine if you're financially ready to retire. Pat also learned at a seminar that she will need to request an official benefit estimate before she can retire, and she can request it when she's 3 to 12 months from retiring. She logs into her online account and selects Request an Estimate. Once she receives her official estimate, she can apply for it, and she should apply for it no later than 5 weeks before she retires. She can apply for it online by selecting Steps to Retirement. To learn about applying for your benefit online, attend a virtual Nearing Retirement seminar or watch the on-demand seminar video. And again, as a reminder, if you're in more than one plan, you'll need to complete a paper application for all plans you expect to retire from. So contact Year S for your official estimate and applications when you're within a year of retiring. So this was a summary of all the tools and resources we have on our website to assist you in planning for your retirement. So contact Year S if you have questions about your pension or applying for it, or anything's related to your retirement or purchasing an annuity. The retirement specialists are available Monday through Friday, 8:30 a.m. to 4 o'clock p.m. From your DRS online account, select Contact Us to send a secured email to a specialist. And if you're in Plan 3 or DCP, contact Voya Financial for assistance in making changes to your investment account or requesting withdrawals. Customer service is available Monday through Friday, 7 a.m. to 6 p.m. And that is the end of the formal part of my presentation. So again, do you have any questions for me? Grace, do you have questions to share with me?
Yeah, I've got a couple in here.
Okay.
Amanda's asking, I'm reading conflicting information. Can we collect or cannot collect Social Security while having pension and 401k?
You can collect all of them and one is not going to impact the other. So if you're collecting a Social Security benefit, taking money out of DCP or PERS, having your PERS benefit, that will not impact Social Security. I think where the confusion might come from is that if you do retire early from Social Security, so you have a reduced benefit, and then if you go back to work and you're contributing to Social Security again, well, then there could be, after a certain number of hours that you work, there's going to be impact to your Social Security benefit. Your benefit's going to be reduced. Sometimes that causes some confusion for folks. But as far as receiving your PERS retirement or DCP, that will not impact your Social Security or vice versa.
Okay. Yeah, Steve Dyer says it'll impact income taxes.
Yeah.
Lana is asking, is there a set tax rate for DCP withdrawal or variable?
It depends on how you take the withdrawal, but for a lot of people, if you take like the occasional partial lump sum from DCP, then it's going to be an automatic 20% withholding for federal income tax. And you would pay, of course, then you file your tax return. So you might get some of that 20% back or might owe more, depends upon your taxes when you file. But there's that sort of automatic 20% withholding. So you can choose to have more than that withheld, but not less.
Lana says thank you.
Okay.
Nope. Kristen says, why does the benefit estimator give me a reduced benefit even though I am estimating a retirement after 30 years and 57 years of age?
Because you get a reduced benefit if you're eligible for the 2008 factors, which is having 30 years in and joining your plan prior to May of 2013, you can only retire as early as age 62 with a full benefit, no reduction. So at age 59, your benefit is reduced because that's under age 62.
Heather said 71, not 73, not 71. I'm not sure what that's referring to, but do those numbers mean something to you, Stacy?
Well, 73 is when if you are no longer working, you do have to start taking withdrawals from your pre-tax balance in DCP, and that's called a required minimum distribution. And that does kick in when you're 73 and older, as long as you're no longer working.
Bill asks, can people make one-on-one appointments for retirement planning with DRS to review retirement process questions?
So you can schedule either a virtual or a phone appointment online through your DRS online account. So if you look at the menu, kind of scroll down the menu from your online account, you'll see an option there that says request an appointment. But outside of that, if you happen to be in the Tumwater area, you don't need an appointment. You can just walk into our office if you want to. But to actually schedule an appointment, that you would do through your online account. And that would be virtual or again, phone, a Zoom appointment.
And I'm so sorry, I'm going to butcher this name. Gunal Silan says, for those who want to work beyond age 65, should they be informing DRS? Should they be providing tentative time?
Nope. So just you can work as long as you want to. It's just 65 for a lot of people is the earliest you can retire and receive your full benefit. If you want to work longer, and a lot of people do, that's great. You still earn credit for every month and year that you work. And you'll just start the retirement process again when you're within a year of when you're ready to retire.
Awesome. That's all the questions that have been shared with us right now. Anybody else have any other questions? You can write it in the chat, or you can just pop on to like undo your mic and ask it.
Yes. You're welcome to do that.
Oh,
I'm just
phone
leaving
number.
our phone number up here in case you want to call DRS. That's always an option too. Yes, looks like Mona.
Yes, so if I choose to work until I'm 70, is there anything I need to do? I mean, I'm sure I'm going to work past that, but at least until I'm 70, is there anything that anyone I need to notify, or I can just continue working as is?
Yep. So you work as long as you want to. There's nothing you have to do with us until you're ready to retire. So let's say you decide you want to retire when you turn 70. We'll just start the process when you're within a year of turning 70. Outside of
Oh,
that, there's
within a
nothing
year.
else. Yeah.
Okay.
So that's what kind of when I was kind of went through Pat here, where when you are 3 to 12 months from retiring, that's when you need to request your official estimate and all of that. So you kind of start that process when you're within a year of retirement. So for you,
Oh,
like for that example, you would start that process when you're within a year of turning 70, if that's when you're planning to retire. Yeah.
okay. Well,
And what I
I'll
would
think
recommend.
about that when I get to it.
Okay, or longer if you want to work longer. But what I would recommend too is because I don't know how far away you are from 70 or working longer, but some of this process could change over time. So I would just recommend review the retiring page of our website, and that will keep you up to date on any possible changes as far as what to do with us. But right
Okay.
now, as it stands, you start that process when you're within a year of retiring.
Well, it's 5 years from now, so I'm
Okay, yeah. I would
good.
definitely check that retiring page when you get to that point then.
Okay, thank you.
You're welcome.
Lana?
Yeah, just to clarify that I heard this right, regarding the 5 years that the amount is based on for your distributions, is it the highest 5 years or the most recent 5 years? And I'm asking because we have some employees who they'll get, as they near retirement, they want to work a little less. They may work for a different state agency or in a different role, might be making less money. So is theirs going to be based on those most recent years or the
So,
prior?
so we kind of jokingly say your high five, but technically it's your highest 60 consecutive service credit months of earnings. So basically finding your highest 60 months consecutive service credit months and taking an average of that. Now, if you've got months in your history and your past where you didn't earn any service credit, they're going to drop out. They don't count, but we'll just push together all of those service credit months to find your highest consecutive 60 months of earnings and taking an average of that. So yeah, changing employers. Sometimes there are people that might take a job, that's maybe less pay, but also less stress. Typically, that kind of thing does not impact your benefit calculation because we'll go back and find your highest 5 years before you took that less stressful job. So really, it's anywhere in your career, just finding that highest consecutive 60 months of earnings.
Perfect.
Hopefully
Thank you.
that makes sense. You're welcome.
Sue?
Yes, it helps if I
I was going to say,
unmute.
I think you're muting.
Anyways, mine's similar to Lana's, but say so you're working till you're 70, and say you started the process 6 months to a year prior to turning 70, and then you change your mind and decide you want to work longer.
Yeah, no one's going to hold you to it.
Okay.
But I would say until you, my recommendation in that type of situation, if you're not quite sure, is just use a benefit estimator, look at those numbers to help you decide. And then, once you're feeling pretty confident that you're ready to retire, go ahead and request your official estimate. But yeah, once you request your official estimate, nobody's gonna hold you to that. So if you want to keep working, that's fine.
Thank you.
You're welcome.
Belen?
Yes, if you work till you're 73, are you still
Mhm.
required to take the withdrawals because you
Yeah,
hit 73?
that will not kick in until you're done working. So if you
Okay,
work until 74, 75, as long as you're working, there's no required minimum distribution that kicks in. But once you're no longer working, that's when you're going to be subject to it.
perfect. Thank you.
You're welcome.
Charles?
Does the PEBB benefit have a premium associated with it?
Yeah, so if you enroll in the PEB Retiree Benefit Program, you are going to pay the full cost of health care. That's why I would recommend definitely attend their webinar because they spend a lot of time talking about all of that. So I would just go to the healthcare page of our website and select that link, and that will take you to the webinar page of their website, and you can sign up for one of their webinars.
Thank you.
You're welcome.
All right, I'm going to go back to the chat. Ingrid is asking for the phone number for Voya again. One of these numbers isn't.
Oh, sure.
These are all DRS numbers, right? On the screen.
Yeah, that's contacting DRS. Let me get to that Voya one here. And there's Voya's contact. And that would be for DCP and Plan 3.
Just gonna, if I could type, I would do this. 888-327-5586. Okay, there we go. That was Ingrid. Phil asks, is the interest rate variable on DCP funds?
Yeah, it depends upon how your money is invested because you're in the stock market for the most part, and those returns do fluctuate. You're always welcome if you go to the DCP webpage and scroll down to investments. You can look up past performance. It doesn't guarantee the future, but it gives you an idea about how the different funds have performed in the past. But yes, those returns do fluctuate.
CJ said, did I miss if you are close to retirement? Is there something specific you were looking for, CJ, with that question?
No, I'm just wondering, she said she was gonna go through all 3 sections, and I was wondering if I missed the last one or we didn't cover it.
Yeah, the
Oh.
last Pat section was all about nearing retirement, so I did go through that.
Okay, I just missed it somehow.
Okay.
I'll shoot you a link with the recording.
Thank you, ma'am.
Okay, Hillary is asking, after age 65, can I collect Social Security and still work full time?
Well, Social Security has different requirements when it comes to eligibility for a full retirement than you do have with your PERS retirement. So I would recommend, actually, we've got a Social Security webinar that's coming up, actually a representative from Social Security who's doing that webinar. And that's coming up, I want to say, tomorrow at 4 o'clock. So if you visit the events page of our website, you can sign up for that, and he'll go through all of that in that webinar presentation. So that's going to be tomorrow at 4 o'clock. And if you visit the events page of our website, you can sign up for that.
This is from Julia, can you provide general information about withdrawal options from DCP? Do you have to withdraw monthly, annual, etc.?
It's really flexible. You can pretty much take your money out however and whenever you want to. So you've got monthly installment, quarterly, semi-annual, annual, change it whenever you wish, or just leave it there and not touch it until you're ready. So really the only requirement that kicks in is when you turn 73 and older, and that's of course that required minimum distribution from a pre-tax balance. But outside of that, there's no other requirement. You can just pretty much do whatever you want once you are no longer working.
Rebecca is asking, when is the earliest you can start taking from DCP? Is it 59.5?
There's no age requirement. You can start taking from DCP anytime after you separate from service. No age requirement. Now, the age requirement only applies if you want to access your account while you're still working, then that's 59 and a half or older. Or if you have a Roth balance and you want those tax-free withdrawals. Those are the only places where age comes into play. But outside of that, no age requirement. You can access your account anytime after you separate from service.
All right, and last question so far. Chad says, when I retire, if my spouse is still working and chooses to go on to I don't know what that's saying, Chad. Sorry. Go on to her insurance. Oh, and okay, so I think this is what Chad's saying. When I retire, if my spouse is still working and I choose to go onto her insurance, can I come back to PEB at a later date?
Well, you do have to enroll in PEP at the time that you're eligible, but you can make the election on their form to defer coverage and then pick it up when your coverage through your spouse's plan ends. But if you don't make that election at the time you're eligible, you will not be able to enroll later. And that's something that is covered during that PEB healthcare webinar that I encourage folks to attend. So you do have to still enroll when you're eligible, but make the election to defer coverage.
Awesome. That is all we have right now. Any other questions that are out there lingering? No. Well, thank you so much, Stacy, for taking your time and answering all these questions. As always, you're so informative and you're so smart, and you just know the ins and outs. I guess that comes from working at DRS for as long as you have. So thank you so much. And I will send a link out to our wellness YouTube page that has all of our lunch and learns and webinars once I get that all uploaded. So thank you so much.
Yeah, thank you, Grace. Thanks for having me. Have a great rest of your day, everyone. Thank you for
Thank
attending.
you too.
Bye-bye.
Thank
Thanks.
you.
Thank you.